Yes, good evening, students. So it's another perfect time. We are meeting again for this live session. So remember that we have done many live sessions. There is videos uploaded in my YouTube channel, which can be able to assist you in the area of financial reporting and advanced financial reporting. So for today, I would like to look at advanced financial reporting. So this advanced financial reporting, remember that it's in the advanced level. Advanced level in which exam? The KASNEB exams. So when you are doing KASNEB exams, to be more specific, the CPA, under the advanced level, there's this paper called advanced financial reporting. So under that advanced financial reporting, there's various topics as a student which you have to cover. Then you will be tested in an exam. Like now, in coming August, we will be having an exam. So for today, I would like to look at consolidation. So that is a consolidation, or we call it group accounting. So whereby you find that there is a parent company acquiring subsidiaries. So parent company acquiring subsidiaries. So that is what I will be looking at today. And to be more specific, whereby you find that when there is a parent company, yes, it had acquired subsidiaries sometimes back. And one of the subsidiary during the current year now under consideration, when you are preparing your books, it was partially disposed so that the percentage of acquisition changed from being a subsidiary to an associate. So on that case, how are you supposed to do your consolidation? So consolidation. So for me to address that aspect of consolidation, and to be more specific, what I've mentioned that where we have a disposal of subsidiaries, I would like to do a question of April 2024. April 2024. So with this April 2024, I will be able to do question 2. Remember, this is just the sitting. After April, remember you have an exam coming August. So for the students who have joined this live session, I would like to share the link to the past paper under the chat. So there's a link I have shared under the chat, which you can be able to use to access this live session. So there is a link I have shared under the chat, which you can use to do what? To access this live session. So consolidation, April 2024. Question 2, advanced financial reporting. Advanced financial reporting. So in my case, I have the hard copy version of the paper. So for you, you can be able to access this paper for a sitting through the chat. There's a link I have shared which will be able to take you to my drive. That is Google Drive. So April 2024 question 2, of which, to be more specific, I will start with B, then I will look at A if time will allow. So in this question, they said that a P Limited, a public limited entity, is a holding company of a group of companies. During the year ended 31st March 2024, P Limited acquired an uncontrolling interest in S. P acquired an uncontrolling interest in S and disposed of part of its shareholding in A Limited. So the foreign draft financial statements relates to P Limited and its investment companies. So you are given a statement of financial position and the statement of profit or loss. So additional information number 1, they are saying that on 1st October 2023, P Limited acquired 80% of the equity interest in S for a cash consideration of 1,300. Additionally, P Limited issued its ordinary shares to the owners of S on the basis of 3 shares for, that is 3 shares of P Limited for every 4 shares acquired in S. The market value of the ordinary shares of P Limited as at 1st October 2023 was shillings 40 per share. This share issue has not yet been recorded in the financial statements of P Limited. So that additional information number 1, I can explain a bit. So the first thing here, we have P Limited. It's acquiring 80% So we have 80% of S Limited being acquired. So that is a subsidiary. So cash consideration, we have the consideration was through cash and through share exchange. The consideration is through cash and through share exchange. So for share exchange, I will be able to interpret later, and so that we determine which amount is there. The amount which was paid through share exchange, other than the cash consideration. Number two, the fair value of the identifiable net assets of S approximated their carrying value as an acquisition date, with exemptions of an item of a plant whose fair value exceeded its carrying value by $700 million. The plant had a remaining economic useful life of 5 years as at 1st October 2023. So when you are told that an item of plant had a fair value exceeding its carrying amount, that is a fair value uplift, which we call it revaluation. So when the fair value is in excess of the carrying amount, meaning that they are trying to tell you that in that plant there was a revaluation, which they call a fair value uplift. So there's revaluation for plant under the additional information number 2, of which you are told that the plant had a remaining useful life of 5 years. So if the asset has been revalued, it has been revalued by 700. It means that that 700 had not been done what? Had not been subjected to depreciation. So we need to determine the depreciation figure, which is inside the revalued amount, which is inside the revalued amount, which is inside the revalued amount, which is inside the revalued amount. So meaning that out of the fair value uplift of 700, we have to determine depreciation under charge using the remaining useful life. Number 3, P Limited had acquired 75% of the ordinary shares of A. So other than P acquiring S, it also acquired which company? It acquired A Limited. It acquired A Limited. So A Limited was acquired at 75%. So meaning again that is another subsidiary which was acquired. So you are told that when the retained earnings of A stood at 240 million, the purchase consideration comprised the cash of shillings 30 per what? Per acquired share. So no fair value adjustments were necessary with respect to the acquisitions of A Limited. Number 4, on 1st October 2023, P Limited disposed 45% of the ordinary shares of A Limited. So meaning that this structure is before disposal. This one is before disposal. Before disposal. Now, after disposal, what happened after disposal? They disposed 45. So 75 minus 45, that is 30%. So P Limited is remaining with 80% control in S Limited. And for this one, it's changing, A Limited, it's changing to 30%. 30%. So 80% and 30%. So we have before disposal and after. So we need to look at time. So that is the period. Our financial year ends on 31st March. Our financial year ends on 31st March 2024. Meaning that it starts on 1st April 2023. 2023. S was acquired on 1st October 2023 acquisition. For A, the main thing you look at, when was it disposed? So disposal took place when? That is according to note 4. Disposal took place on 1st October 2023. So acquisition was on for A Limited. Acquisition was on some time back. That is according to note 3. Acquisition was on 1st October 2019. And 45% was disposed. 45% was disposed on 1st October 2023. That is the period when it changed from 75% to 30%. From being a subsidiary to what? From being a subsidiary to an associate. So, and that one tells me that S was acquired on October 1st, 2023. So from October to March, those are 6 months. 6 months, 6 months. And I can see there's a coincidence. This period when they acquired the S is the period when they disposed the A. It's the period when they disposed the 45% of A. So I can come here and say S Limited, 6 months subsidiary. It's a 6 month subsidiary. Then we have A Limited. A Limited is a 6 months. 6 month subsidiary. And what? And at the same time, A Limited is a 6 months. 6 months associate. Because A Limited was disposed the same time when they acquired S. So from April to October 1st, it was a subsidiary at 75%. At 75%. 75%. So here we have, this one is 80%. Here we have 75%. And here we have, it changed to be 30%. 30%. Because from October to the end of the year, it's changed from 75 to 30% due to the disposal of 45%. Note 5, they said that the group's policy is to measure the non-controlling interest in subsidiaries at their fair values at the acquisition date. The fair value of the non-controlling interest was shilling 750 million for S and 200 million for A, as at the respective dates of acquisition. This implies that when you will be computing the goodwill of these investee companies as at the time of acquisition, that is the period when they were subsidiaries, when you will be computing your goodwill, you have to use full method, or we call it fair value method. Fair value method. Note 5, it's a guide that when computing the goodwill, use the full method, because already the NCI is measured at what? The non-controlling interest, sorry. Let me use the full name. The non-controlling interest is measured at fair value. It's measured at fair value. Number 6, during the post-acquisition period, P Limited sold goods worth 1,000 on cash terms to S Limited. P Limited reported a gross profit margin of 20% on this sale. 1/4 of these goods remained in the inventory of S as at 31st March 2024. So P was selling goods to S. He sold the goods and made a profit of 20%. But looking in the books of S, by the end of the year, 1/4 of these goods remained in the inventory. So meaning that there is unrealized profit in the goods which are unsold in S. So we need to determine that unrealized profit on the unsold goods so that we eliminate in the books of P Limited to avoid the profit overstatement. To avoid profit overstatement. Number 7, neither goodwill on acquisition nor investment in associate had suffered any impairment, so there is no impairment. Profits and losses of all the group companies are deemed to accrue evenly throughout the financial year. Neither S Limited nor A Limited had issued any ordinary shares since P Limited acquired shares in the two companies. Calculate the gain or loss on disposal of shares in A Limited to be presented in the consolidated statement of profit or loss. 6 marks. Also, they need preparation of a consolidated statement of financial position as at 31st March 2024. That is 10 marks. So we can start with the first requirement, gain or loss on the disposal of shares in A to be presented in the consolidated statement of profit or loss. That is what we can do first. So the first part is gain stroke loss. Gain stroke loss on disposal of S Limited to profit or loss statement, to statement of profit or loss, to statement of a profit or loss. Profit or loss. To the statement of profit or loss. So you can have two columns here. Shillings, remember it's in million. And I have shillings in million here. Shillings in million and shillings in million. So the first thing we check when they disposed this subsidiary, the proceeds they made, what they received. So going to the note, going to note what? Note 4, they said P Limited disposed 45% of the ordinary shares of A for cash proceeds of 720. So disposal proceeds. So that is 700 and what? 720. So they disposed and they got 720 million. The remaining equity interest in A Limited held by P was fair valued at 680 million. So today I have disposed. Let me say this is an item I am disposing. I have received a certain amount, which is 720 million. But on the disposal of this item, I have retained 680. So meaning that is also a benefit to me. A benefit to me. So we need to add the fair value of a retained interest. Retained what? Interest. So that is 680. So that is 14. Then now you have to raise various items here. So we say raise net interest disposed. Net interest disposed. The net, what we disposed? The net interest disposed. So we start with net assets which were disposed. Net assets, then what? Disposed. Net assets disposed. So looking at was it A or was it S or A? It's A, not S. A Limited is the one which was disposed. Gain or loss on disposal of A Limited to statement of profit or loss. So P Limited disposed of 45% of the ordinary shares of A at cash for cash proceeds of 720. The remaining equity interest in A held by P Limited was fair valued at 680. The disposal of the shares of the disposal of shares in A is yet to be accounted for in the financial statements of P. We'll account. So if we want to get the net assets, look at the statement of what? Statement of financial position. Look at the statement of financial position. So under the statement of financial position, there is ordinary share capital, share premium, and retained earnings. And there is that retained earnings. So the total is 1940. So the total is 1940. The total net assets. But remember, we need the net asset as at the disposal date. At net asset disposed at the disposal date, which is the middle of the year. So for us to get the net asset at the disposal, we need to know the profit for the year. Profit for the year from the income statement is 320. So for me to get this profit at disposal, which is as at this date, that is from the start of the year up to here. But this one was 6 months. You remember how we did analysis? So for me to get the first 6 months, which is as at the disposal is this date, first 6 months, I will take 1940 minus. So I get the profit for the year for this period. I deduct from 1940 because all other items remains constant. That is the ordinary share capital and share premiums. They remain constant. The only change can only happen under the retained earnings. So the other items remains constant. That is why I am deducting only the profit of a half of 320 from 1940, so that I get the first half, which is the period at disposal. So 6 over 12 times 320. So this is 160. If I minus 160 from 1940. So for the guys following, you can give me the answers through the chat. You have that option. You have that option of providing the answers through the chat. As I pick my calculator to confirm your answers. So 1940 minus 160, that is 1780. So that is the net assets at disposal. Net assets at disposal. Then after that, net asset disposed has been deducted. We need to get the goodwill. You write goodwill disposed. Goodwill disposed. The goodwill disposed. And that one takes me to the computation of goodwill. So computation of what? Computation of goodwill. Computation of goodwill. So goodwill is all about purchase consideration. Purchase consideration minus what? Net assets. Minus share of net assets. And we are using full method because we have the favor of the non-controlling interest. That is according to note C5. The favor of the non-controlling interest for A is provided at 200. So I can have shillings in millions. And I can say shillings in million. So the purchase consideration was Look at additional information number 3. There's a sentence they are saying that purchase consideration comprised the cash of shillings 30 per acquired share. Comprised the cash of shillings 30 per acquired share. So here you take 75%. Remember, they acquired 75% in A. And what you need to know is that goodwill is done at acquisition. So at acquisition, it was at 75%. 75% of the acquired share. For you to know the number of shares acquired, you look at the ordinary share capital from the statement of financial position. The power value is 10. The total value is 400. So 400 divided by 10. You get the number of shares. The price is 30. The price is 30. Yeah? The price is 30. So 0.75 times 40 times 30. Are getting 900. Because it's full method, we need to add back fair value of a non-controlling interest, NCI, non-controlling interest. It was 200. So far the total there is 1100. Then now you raise net assets, fair value of net assets. Fair value of net assets. Net assets, we have ordinary share capital. We have ordinary share capital. So the ordinary share capital is 400. We have 400. After that, we have the share premium. Share premium is 100. After share premium, we have retained earnings. Retained earnings. So retained earnings is retained earnings. But now retained earnings at acquisition. At acquisition date. So when they acquired this A, when was A acquired? Sometimes back. When the retained earnings was 240. That one is provided under note 3. When the retained earnings of A stood at shillings 240. When the retained earnings stood at shillings 240. So this total is 5. That is 500 plus 100. That is 500 plus, that is 740. So 1100 minus 740. This is 360. 300 and what? 360. So that is goodwill. Remember, if there was impairment, we have to deduct, but there was no impairment. Under additional information number 7, they said that there was no impairment. So goodwill disposed 360. Goodwill disposed 360. The 360. So, but remember, when they were doing disposal, when they were doing disposal, the parent was not controlling everything. The parent was not controlling everything in the subsidiary. There was the aspect of NCI. There was the aspect of NCI. So meaning that we have to do what? We have to determine some value for NCI. So here I have to do a working concerning fair value of NCI at the disposal. Fair value of NCI at the disposal. And this one is concerning profit. So fair value of NCI at the disposal. Fair value of NCI at the disposal. We have to deduct. We have to raise. To get the net interest to be deducted from 1400, we have first to raise the NCI. So here we have to deduct NCI at disposal. The value of the minority shareholders at the disposal. So fair value of NCI, already we know that the fair value of the NCI was 200 as per note 5. As per note 5. Fair value of NCI. Fair value of NCI at acquisition. Fair value of NCI at acquisition. That is 200. That is 200. And now we need to add what? The pre-acquisition. Pre-acquisition. The pre-acquisition. Or just the profit during the period when it was. Remember, we have NCI when it was a subsidiary. That period from the start of the year. That is what I'm saying pre-acquisition. This period from here to here. That is when we have an NCI at 25%. But the total percentage of control was 75. So NCI is 20. So I can say pre-acquisition profit. Pre-acquisition profit. So from start of the year to mid year. So how would I be able to get that profit? How can I be able to get that profit? That profit. That profit. So if I look at my statement, if I look at my statement of financial position, as at the end, remember that the items under the statement of financial position, they are provided as at the end of the year. As at the end of the year, we have 1440. 1440. So we need at the disposal. And we know that the profit for the year for A is 320. Is 320. 320. So you can be able to get at the disposal the retained profit. Because I will just take 1440 minus this period. So I will apportion this. I get for the last 6 months, I deduct from 1440. So that is 1440 minus 160. That is 1280. That is 1280. That is 1280. But remember, at acquisition, other than the 1280 which we have for this period here, 1280, at acquisition, there was a retained profit of 240 at acquisition, which again is in here. But the 240 is at acquisition. At acquisition, not at disposal. Sorry. At acquisition, yes, sometimes back, this 240 was there. At acquisition, 2019, when they acquired A, there was 240. So that 240 is also included here. So meaning that it's also inside here. After getting this 1280, again, we need to raise this 240, which was present as at the time of acquisition, because that amount is inside the 1440. So I will come here and say 25%. 25% times what? 1280. I deduct 240, which was there at acquisition, because that amount is this 240 is affecting the 1440. Consequently, it has to affect the 1280. So 1280 minus 240 times 0.25. That is 200 what? 260. So meaning that the favor of the NCA at disposal is 460. That is what I will do what? I will deduct. That is the value. I will do what? I will deduct here 460. For me to get the net interest disposed. So my net interest disposed will be 1780 plus 360 minus 460. So that is 1680. So deduct it from 1400. 1400 minus answer. It would be a loss. Loss on disposal. It will be a loss on disposal. It will be a loss on disposal of 200 what? 280. So it was having 6 marks. So from my equation is 6 marks. So it was having 6 what? 6 good marks. But now the funny thing is all about, or the good thing, not even the funny thing. The good thing, I will be able again to tell you how you were supposed to get the 6 marks. That is the good thing of studying with Ochoi. I will be able to tell you how this one was marked for you to get what? The 6 marks. And that is the benefit. If you join my classes, you will be first, we do a question. Not even do a question. First, we introduce a topic. If it's consolidation, I introduce it. That is giving you the key terms, key adjustments. I explain everything. And any other theory part, which is required in consolidation, before we hold the questions. Then we pick around 4 questions for us to cover the concepts. We solve them. So these classes I do through the Zoom platform. So for the students I can see following, you can join. You can join the online classes. My number is here. So that is my contact for whoever wants to join my online classes. You can WhatsApp or just call. So I was trying to show you how you are supposed to get these 6 marks. So they mark entries. Remember in AFR they mark entries. So this is a mark, this is a mark. Then after that, this, and this. So there was 1, 2, 3, 4, 5. So we have 5 entries and we have 6 marks. How will you be able to get the 6 marks? Out of these 5 entries, they need any 3. Any 3 you multiply by 2, you get your 6 marks. So they don't need all of them. You don't have to score all of the 5. They just need 3 correct. So out of the 5, if there is any 3 you scored, you will be able to get your 6 marks. You will be able to get your 6 marks. Is that okay? So let's shift to the second part of this question. That is doing the statement of financial position. So that is doing the statement of financial position. So remember that for the statement of financial position, you have to be keen on analysis when there is a disposal. Remember, we said that our financial year ends on our financial year, according to the question, our financial year was ending on 31st March 2024. It starts on 1st April 2023. 1st April 2023. The disposal of the acquisition of S and disposal of A happened on October 2023. Disposal and acquisition. The acquisition of S, October. Disposal of A, October. Because A was acquired in 2019. So I went ahead to mention that this is 6 months, 6 months. So we said that S was there for 6 months as a subsidiary. Then A was present for 6 months as a subsidiary, and at the same time 6 months as what? Associate. But that one doesn't affect much our statement of financial position. This one could have affected this one. The timing could have affected the statement of profit or loss. When you are doing the statement, if I was to do P, statement of profit or loss, I could have taken P plus the subsidiary, but now subsidiary I could have said 6 months plus also another subsidiary A for 6 months. This is a statement of profit or loss. For statement of financial position, it's just P plus what? P plus S. Because a statement of profit or loss is a statement for the year. Then a statement of financial position is prepared as at the end of the period, as at this date. So when doing statement of financial position, you will look at by the end of the year, as at this period, these investee companies with the parent control, which one was a subsidiary? Which one was a subsidiary by the end of the year? Unlike the income statement, which we have to look at how they were behaving during the year. That is why for the income statement, you will have to consider this subsidiary for 6 months and A as a subsidiary for 6 months. But remember, by the end of the year, it's S, which was a subsidiary. A was an associate. It was disposed 1st October 2023. By the end of the year, A was an associate. So we will only consider S. But under A, we need to look at maybe some few items, like now the investment which the parent made in that associate, so that he gets some return. So P limited, consolidated what? Consolidated statement of financial position. Statement of financial position as at what? As at 31st March 2024. As at 31st March 2024. So here we have shillings in what? Shillings in million. Shillings in million. So we start with assets. We start with the assets. So to be more specific, we have the non-current assets. We have the non-current assets. We have the non-current assets. So under the non-current assets, we have the property, plant, and equipment. So in short, I would say PPE. So we take parent plus subsidiary. So S was the only one which was a subsidiary by the end of the year. A was disposed by this period and it changed to be an associate. So by the end of the year, A was an associate. So I would just take parent plus subsidiary plus revaluation. By revaluation gain, the fair value uplift. The fair value uplift. The fair value was in excess of, under the plant, there's an additional information where they say that the plant had a fair value in excess of carrying amount. In excess of carrying amount. The amount was 700. So this is a fair value uplift, which we call it a revaluation gain. So revaluation gain, debit, property, plant and equipment, credit, revaluation reserve account. Credit revaluation reserve account. So that is why I need to add, it was 700. Then they said it had a remaining useful life of 5 years. That is what they said in note 2. The plant had a remaining economic useful life of 5 years. As October, as at which period? As October 2023. So from October 2023 to the end of the year, our financial year ends on the 31st March 2024. So we have 6 months. And that one means that when we have the economic useful life, we need to determine depreciation. The remaining useful life, we need to determine depreciation. And this depreciation is a depreciation undercharge. Because we have not subjected the revaluation of 700 to depreciation. So I will come here and say 700 divided by the useful life. But now remember, it's from October to the end of the year. That is 6 months. 6 months. So this is, so that is, so if I say 700 divided by 5, times 2, times a half, times 0.5, that is. This is 70. So with depreciation undercharge, it means that our value of the asset was overstated. With the depreciation undercharge, it means that the value of the asset, the property, plant and equipment, because the plant is classified under property, plant and equipment. With the depreciation undercharge, our plant was overstated. So we need to credit PP. And at the same time, profit must be affected, because with the depreciation, which is an expense, being understated, our profit was overstated. We debit retained earnings to reinstate it to its normal state, or we just say to reinstate it. So meaning that I to minus 70. I need to deduct 7. So 4,400 plus 4050 plus 700 minus 70. So this is 90, 80. After that, we have investment in S. Investment in S, we determine goodwill. So goodwill, so that is our working. That is our working to be done. So I can go ahead and do the working. But at some time you can skip. You do other items which needs just direct entries, so that you come back to do the one which needs working. But for this one, I can do goodwill as we continue. So goodwill, remember, it's equals to purchase consideration. Purchase consideration minus share of net assets. So the purchase consideration was bought in cash. Was bought in cash and share exchange. That is note 1. Was in cash and share exchange. Share exchange. That is what they said in note 1. We have a cash consideration of 1,300. P issued its ordinary shares to the owners of S on the basis of 3 shares. So for share exchange, for shares, we need to determine the value, because they said on the basis of 3 shares of P, 3 shares of P, 3 shares of P limited, 4 shares of S limited. So you need to look at statement of financial position of S. But what you need to know that they acquired 80% of the shares of S. So from the ordinary share capital, that is under the statement of financial position, I can be able to see We have 1,000. This is the capital. The par value is 10. So they acquired 80% of these. 80% of 100. So it's say 3 is equals to 4. What about 32? It was, so this is 80, not 32. What about how many shares they acquired? So we say 80 times 3 over 4. So P acquired how many shares in S? P acquired. So that is 240 divided by 3, divided by 4. P acquired 60 shares. So the value will be, so you come here and say ordinary share capital. Ordinary share capital. So the ordinary share capital is obviously presented at par value, of which our par value is shillings what? 10 from the statement of financial position. We have 600. But if you look at note 1, they say that these shares, not these shares. In note 1, there is a sentence in between that paragraph whereby they are saying the market value of the ordinary shares of P on 1st October was shillings 40. So we have a fair value of 40. A fair value of 40. And we have a par value of 10. So we have presented our ordinary share capital at par value. And this fair value is in excess of the par value by 30. It was 40 minus 10 is that. Any amount above the par value is what we call share premium. Any amount above the par value is what we call share premium. So I come here and say 60 times shillings what? 30. The share premium, the amount above the par value, that is 18. And that one adds up to 2,400. 2,400. So that our goodwill will be purchase consideration So I can clear this one. I think you have understood. For the guys following. For the guys following, I think you have understood that we have 2,400 there, of which 600 is the ordinary share capital and 1,800 is the share premium. So purchase consideration is we have both in cash and the share exchange. But I could have even done direct. If I was to do direct, this is the way I could have done the determination of the purchase consideration for the share exchange. But I have shown you, I have just interpreted how we were getting 2,400. It can be done direct. We have cash of 13, and we know that for the share exchange, it was 3 for every 4 terms. Remember that it's an 80%. They acquired the capital. You look at the capital. The capital of S is 1,000, of which you divide to get the number of shares, which is 10, the par value, times the market price. The market price is at 40. That is how you can do it direct. And these ones will give you the 2,400. The 2,400. So 1,300 plus 2,400. So this is 3,700. Then now you raise the fair value of net assets. The fair value of net assets. So net assets, we have ordinary share capital, we have share premium, we have the retained earnings, we have even the fair value uplift for the plant from the additional information. From the additional information. But before we talk about the fair value of the net assets, you need to remember that we were using which method? Full method. And why am I saying that full method? We have the fair value of NCI. So before we raise the net assets, we need to add the fair value of NCI. That is from additional information number 5, which is 750. We need to add 750 because it's full method. It's a full method, not a partial. Remember, when we have a partial method, it means that you are not provided with fair value of NCI. There's nothing to be added there. But for this one, we have the fair value of NCI, and this one gives us a total of 4450. Then you raise the fair value of net assets, fair value of net assets. So we have ordinary share capital. Ordinary share capital. Ordinary share capital for S is 1,000. That is 1,000. Share premium is 200. So for the students saying kindly share the question is under the chart. So you see under the link I have shared, use that link. Esther, use that link to access the past paper from my drive, my Google Drive. So, share premium, the next one is retained earnings. Retained earnings. You know very well that retained earnings, you pick the value as at acquisition. And this one was not provided direct. So you have to use your knowledge for you to get at acquisition. S was acquired 1st October. But our financial year runs from April to March. S was acquired on 1st October. So meaning that we have 6 months. So at acquisition is from the start of the year, April 1st to October 1st. So by the end of the year, which is March, based on the statement of financial position, you know very well that the items under the statement of financial position are as at the end of the year. So the retained profit of 2670 is as at this period, end of the year. Then we have the profit for the year. We have this profit of 540. Profit for the year from the income statement. See, I can be able to get this first 6 months because I know here is 6 months. So if I take my 2670, then I deduct the profit for this period, which is 6/12 times 540. If I deduct that one from 2670, I will be able to get this period, the profit for the first 6 months. The profit for the first 6 months. So 2670 minus 270. So that is 2400. So that is 2400. Then we have fair value uplift. The revaluation gain. Fair value uplift. The revaluation gain for the plant, which is also which must be at acquisition. When they are providing that revaluation, they will obviously mention that it's as at acquisition, and that is what they did in additional information number 2. The fair value of the identifiable net assets of S approximated their carrying values as at the acquisition date, with the exceptions of an item of plant whose fair value exceeded its carrying value by 700 million. So the 700. So those are the net assets. So 1,200 plus 2,400 plus 700. So that is 43. So if it's deducted, our goodwill will be, so 4450 minus, so this is 150. So we have 150 here. 150. Then what about investment in what? Remember that investment in subsidiary, you replace it with goodwill. That is what I have done. Then in investment in associates, also you determine using IS IS what? 28. International Accounting Standards 28. In the determination of the investments in associates. Because by the end of the year, why am I saying investment in associates? By the end of the year, March, A was not a subsidiary. That is why it has not been added. So A is by the end of the year, A was an associate because it was disposed on October. So we need to determine the investment in associates. Investment in associates. We need to determine the investment in associates. So investment in A, which is an associate. Investment in A. So remember that it was from the start of the year, it was 75. Here, 45 is disposed, 45%. So meaning that we are retaining what? Retained interest is 30%. Retained interest is 30%. Or with this one, they say at a value of 680. That is what they mentioned in note 4. The remaining equity interest in A held by P was fair valued at 680. Was fair valued at 680. That is what I will start with. Fair value of 30% at disposal. Fair value of 30%. Fair value of 30% at disposal. In short, the retained interest. In short, you can say retained interest, which is 600 and what? Shillings in million, which is 680. That is according to note 4. So because from this period to this period, that is when we have 30%. Then now we need to look at, in this period, the profit was, so we call it post-acquisition profit. So add post-acquisition. Add post-acquisition what? Post-acquisition profit. You add the post-acquisition profit. So for the post-acquisition profit, we know very well that the profit for the year, profit for the year, from the income statement is 320. So you can be able to tell me this one, because it's 6 months. So your portion, so you say 30% times 320, but now for the last 6 months. So that is 160. 160 times 0.3. Our final answer here will be 48 for the post-acquisition profit, giving us a net investment of, so 680 plus answer, that is 728. 728. But that is a working. That is a working we have done. So before we go to the current assets, we can say total and current assets. So the total and current assets there. So 9080 plus 150 plus what? 728. So this is 9958. 9958. So current assets, I can see there's a block figure. Block values, because you know current assets are many. In the ranks of inventory, receivables, cash, bank balance, prepayments, but they are giving us a current assets as a block figure, 1500 plus 1500 plus 1250. So we have the aspect of unrealized profit on stock, which will affect unrealized profit on stock. So there were goods which were sold. That is according to note. That is according to note 6. There were goods sold from P. P limited sold goods to P sold to S. Some goods. P limited sold goods to S. So selling price. We have a selling price of shillings 1,000. Profit margin. We have a profit margin of 20%. But in S, unsold goods. Unsold goods is a quarter. So I can be able to determine the unrealized profit in S based on the goods unsold. Unsold goods is a quarter of 1,000. A quarter of the 1,000 because that is the unsold. Times profit margin. 20% is like a fifth. Not like it's a fifth. The fraction of 20% is a fifth. So 1,000 divided by 4 times 1/5. That is 50. Remember the sale was downstream. So meaning that the profit is overstated here. That 50 is overstated here. So which account to be debited? Which one to be credited? Which one is to be debited? Which one is to be credited? So if the profit is overstated, we need to eliminate that profit overstatement of 50 in these books. So by debiting retained earnings account in the books of P Limited, retained earnings account is debited. You credit inventory account because it's goods which were sold. So that is why crediting means deducting here. I will deduct 50. I will deduct the 50. So I will deduct the fee 50. So after deducting the 50, remember that there was this entity which was disposed. That is A. That is according to note 4. So when P Limited disposed the A, there is that cash he received of 720. So that is a current asset. So the cash received on dispose of A. That one totals to 3420. And that one gives me a total assets. The value of total assets 9958 plus answer 13378. 13378. So let's go to equity. Let's talk about equity and what? And liabilities. Equity and liabilities. So let's talk about equity and liabilities. So equity and liability, I start with equity. I start with the equity. So for equity, we have ordinary share capital. We have ordinary share capital. Ordinary share capital. So ordinary share capital, here you pick for the parent. For the parent, we have 2,000. Plus, there was those shares he acquired when he was purchasing S. the purchase consideration, which was through shares. So this one I can even determine direct, because it was 3/4. But I remember I interpreted 3/4 times 80%. Remember, the value of the capital in which entity in S was 100 shares, because 1,000 divided by 10 times the power value shillings 10. That is how we get the ordinary shares. I did this. I did an explanation when we were doing a purchase consideration of S through share exchange. So it was 600, giving us 26. Then there was again a share premium. So first we have 800 plus the one he acquired, that is 3/4, times 80% times 100 times, remember that the power value is 10. The market value was 40. So the value which is above the power value is 30. I talked about that earlier. So that is 1,800 plus 800, 26, 2,600. Then after that, we talk about retained earnings. But this one needs our working. This one needs our working. So I just say working. So I will skip a space there. So that up to that point, you get what? You get equity, the total, this equity, this is the equity. The equity attributable to group owners. That is to the parent and the subsidiary. So to the group owners, equity attributable to the group owners. Then you'll come and check out the minority shareholders. You'll come and look at non-controlling interest, which again needs our working. After that, remember that is up to this point you have total equity. You have a total equity. Then we look at non-current liability. I can see there's many students who have maybe seen me online, they are calling. So you will call later, kindly. So the non-current liabilities. So for the non-current liabilities, also is a block figure of 13 plus what? Plus 800. 13 plus 800. You have 1,300 plus 800. So that is 21. That is 2,100. Then finally we have current liabilities. So for the current liabilities, that is 720 plus 630. 720 plus 630. That is 1,350. You can see some of the entries are direct, just adding parent plus subsidiary. So total equity and liabilities. Total equity and liabilities. So let's do these two workings: retained earnings and non-controlling interest. The retained earnings and what? The non-controlling interest. So for the retained earnings, that is our working I'm doing. Remember, I have to consider the retained earnings of the parent and what is getting from both the S and A. So for P Limited, which is maintained at 100%. So retained earnings of P Limited is 3280. And now we look at S, of which remember that before we go to the disposal, yes, I can say we add what? Add what is getting from S. Share post acquisition profit. Share of post acquisition profit. So share post acquisition profit, we talk about S Limited and we talk about A Limited. Remember, S was there for 6 months from October. That is when it was acquired to the end of the year. To the end of the year. Share post acquisition profit. So for the share post acquisition profit, share of post acquisition profit, how would I be able to get the profit for this period here? How would I be able to get the profit for that period? For S. Let's look at statement of financial position. The profit as at the end is 2670. The end there is 2670. That is 2670. Profit for the year is 540. Profit for the year is what? Is 540. Profit means that the profit as at this date was by this time. The profit by this time here, as at acquisition here. So meaning that 2670 minus 270. Here we have 2400. 2400, yes. Because if I take 2670 minus a half of 540, I get, because I'm deducting just these profit, which is for these 6 months from 2670, so that I get from here to here. So which is 2400. But only this one is for this one without a lot of stories. For this one, it's just 270. Because you just apportion 540 by 6/12. Because here we have 6 months. It's the same way taking 2670 minus 2400. So that is the post-acquisition profit. But what can affect this profit? What else can affect this profit? What was affecting your profit? Remember we said with the depreciation undercharge? With the depreciation undercharge? Credit PP, debit retained earnings. So debit retained earnings. Depreciation undercharge, which was due to? We have depreciation undercharge, which is due to revaluation. So that this depreciation undercharge was overstating our profit. So meaning that when I will be coming to adjust my S, I need to take 80% of 270, but I deduct that depreciation. I deduct the depreciation. So this one I get 160. Then for A, it's just 30%. Remember the profit for the year. Profit for the year for A. The post-acquisition profit for A. Profit for the year for A is 320. Meaning that for the last 6 months, just say 6/12 times 320. Because the profit for the year is 320. So to get the post, which is the last 6 months, you just apportion that 320 by 6/12. which is 160 times 0.3. This one is 48. That is 8. That is 48. Then remember that other than the profit they made, there's a disposal which was done. A disposal which was done. Dispose of A. When they disposed the A, they made a gain or what? Anyway, when they disposed the A, what amount they received? What amount they received? So I would have to add what they received. I can say just again, it's like again, gain on disposal of A, or just a proceed, gain on disposal of A limited. Gain on disposal. Remember that when they disposed the A, they received 720. That is according to additional information number 4. They received 720. They received 720. But remember, they disposed what? Receiving 720. What did they dispose? Assets. They disposed. Not assets. They disposed the equity components, which is shares. They disposed the shares. So they disposed 45%. 45%. So we need to minus here. So that so 45% of that is what they disposed. 45% of the shares. So the shares of A, remember we have 400 divided by the par value, times what? Times the fair value. Fair value was shillings 30. That is what they said in additional information number 3. It was 30. So we need to deduct that one. So 0.45 times 40 times 30. 540. So 720 minus this one is 180. So that one must be added. Also, we need to add what they retained. We need to add what they retained. They retained interest in A. So you need to add retained interest in A limited. The retained interest in A limited. So the retained interest in A limited. Remember the retained interest, when they disposed this A, they retained 680. That is according to additional information number 4. But now we need to minus the 30% which they retained, the 30% of what? The 30% of the shares, because what they retained is just the value of the shares. So 400 over 10 times shillings what? Shillings times shillings 30, which is the fair value. Which is the fair value. So 0.3 times 400 times 30. Not 400 because it's 4 shares, not the that is 360. So that is 360. 680 minus answer. This is 320. Then finally, what can be deducted here? Remember we said for the UPS, for us to eliminate it in the books of P limited, due to those goods which were sold, we have to debit retained earnings, we credit the inventory. Already we credited our inventory. So we need to debit retained earnings. That's UPS, which is 50. So that the retained earnings will be, so 3280 plus 160 plus 48 plus 180 plus 320 minus 50. So that is 3938. So we have 3938. And that one gives us an equity attributable to the group owners of, so plus 50 what? 52 plus 200. This one is 9138. So for the NCI, last but not least, for the NCI, for the non-controlling interest. For the NCI, non-controlling what? Interest. So first we start with the fair value of the NCI, which is according to note 5. So fair value of NCI. So the fair value of NCI as per note 5 is 750. That is 750. Then we add the post-acquisition profit. Add post-acquisition profit. Post-acquisition, which we already know. Post-acquisition profit. Our post-acquisition profit was, so we know it's here, 48. The 48. The post-acquisition profit, the 48. Is it 48? Post-acquisition profit, it's for which entity? Not for A, but in S, sorry. Remember the NCI is under S, not A. Not A. There's somewhere we got that post-acquisition profit, not for this one, but remember it's for S. Remember I said that we apportion the profit for the year for S, which was 5. It was 540. So when we apportion for the last 6 months, I said it's 207. 6 months, 6 months. That is NCI will be 20%, because in S it's 20%. 20%. That is 20% of the 270. But I said we have to reduce the 70, which is depreciation. Depreciation must affect retained profit. Because we said with the depreciation undercharge, debit, retained earnings, credit, property, plant, and equipment. So that is 200. So giving me 40. This one gives me 40. So the non-controlling interest will be 790. So 91, 38 plus 790, that is 99, 28. Plus 2100 plus 1350. That is 13,378. 13,378, which is equal to the total assets. So total assets and total equity and liabilities, they look the same. They have to be equal. They have to be equal. And that is how you were supposed to do this question for consolidation. That is for April 2024. Advanced financial reporting. The advanced financial reporting. How are you supposed to get the 16 marks? Very important. You have to know. So for 16 marks, this is how you were supposed to garner the 16 marks. This is how you were supposed to get the 16 marks. So this one was having 2 marks because at some point you could have separated. You could have separated these and you could have separated. You just post this 2, which is at 80 what? 8450. Then you post 770. 770 or 6 what? 630. You could have posted this separately. You could have scored. If you say 8450, and this one you post separate as what? As 630. So that is why you are getting 2 marks here. 2 marks there. Then you have goodwill, 1 mark, 1 mark. Then you go to the current assets. Even current assets, you could have scored. This one is 2 marks. Why? Because if you could have posted this as cash, 720. If you could have posted that one as 720, then for the other one, which is 1500 plus 1250 minus 50, 2700. But this could have been posted as 2700. You could have scored. Eh? So that is why we have 2 marks there. Then we have 2600. That is 1 mark, 1 mark. This is 1 mark, 1 mark, 1 mark, 1 mark. So they don't mark totals. Eh? 1 mark, 1 mark. It's okay. So means the entries are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. We have 12 marks. 12 entries, eh? Not 12 ticks. 12 ticks. 12 ticks. But now, were you supposed to get all the 12 for you to garner the 16 marks? For you to get, not 16, it was 10 marks, sorry. For you to get the 10 marks, because the first one was having 6. Eh? So for you to get 10 marks, they needed, out of the 12, any 5, correct? They needed any 5, they multiply by 2. You get your 16, you are 10, not 16. You get your 10. So you can see like now, this one is more direct. If you could have added this and this, you get a mark. That is 1. That is direct. If you could have done what? Another direct one is this. Non-current liabilities is direct. That is another one, and this is another one. So 1, 2 doesn't need doesn't need any. This one doesn't need any workings. 1, 2, 1, 2, 3, 3. Maybe if you could have done this again, even if you could have ignored the 720, they could have marked it 27. That is 4. So 4 times 2, that is 8. You could have scored 8 out of 10 without a lot of the workings. Like now for Goodwill, investment in associates, and this aspect of ordinary share capital, because you have to add these they acquired and this retained earnings needs are working, and controlling interest needs are working. So without workings, you could have scored 8 marks, and that is how they mark the exam. It's very easy. It's very easier to pass when you know what you are doing, when you are with the right person who is guiding you. And that is why I always say that for you to do more of the work in advanced financial reporting and at the same time financial accounting. So there's a Zoom classes I do. Like now today we have a financial reporting from 8 p.m. to 10 p.m. So you can join. Eh? So joining means that you call me for more information using this number 0728 760 546. Once you join, you will be able to cover the syllabus. You will be prepared well for the coming exam. And once you are prepared well, the pass is an automatic. It's not an option. Thank you for your time. Remember to subscribe to this channel. Never just watch. Kindly subscribe. Share. I know there's some students who doesn't, who are not aware, who are not aware about this channel and are doing this unit. So share the link to other accounting platforms so that we can achieve the relevant goals. So karibu sana next time when I will be doing another live session.